Every night, while you sleep, trillions of dollars move across the planet silently, invisibly. They don't make noise. They don't need trucks or vaults. It's just numbers, billions of transactions flowing through fiber optic cables, vanishing into accounts and reappearing as something called debt. You don't see it. You don't vote for it. But it shapes the price of your food, the value of your paycheck, and even the outcome of wars. Right now, humanity owes more than $315 trillion. That's 4 times the total value of everything the world produces in a year. If you spent $1 million every day, it would take you almost 900,000 years to spend that much money. It's such a big number that the human brain can't process it. So we stop trying, we shrug, and move on. But here's the question no one asks. If everyone is in debt, who is the creditor? If every government owes, every corporation borrows, and every family pays interest, who's collecting the payments? The answer is stranger than any conspiracy theory because it isn't hidden at all. It's right in front of us. The real creditors are us, our pensions, our savings, our insurance, our taxes feeding a global machine that converts human time into financial interest. Debt has existed longer than money itself. In ancient Mesopotamia, 4,000 years ago, clay tablets recorded not transactions but debts, promises to pay grain or silver later. The great empires, Babylon, Rome, Britain, all rose on credit. When Rome stopped conquering new lands, its debt stopped being paid. Interest stopped flowing. Collapse followed. Economists later called it the debt trap of empire. After World War II, the United States built a new version of that empire, the Bretton Woods system. The dollar became the axis of world trade, and every currency was tied to it. The dollar itself was pegged to gold at $35 an ounce. For a while, it worked a balance between trust and restraint. But by the late 1960s, America was printing more dollars than it had gold to back them. In 1971, President Richard Nixon ended the gold standard, and the dollar became just paper backed by nothing but belief. That moment changed everything. From then on, money was debt. Every dollar in circulation came into existence as a loan, owed to a bank, with interest attached. The world had entered the age of infinite credit, an economy that could grow not because of production or labor, but because of borrowing. Look at your paycheck. You pay taxes, insurance, maybe a mortgage. You think you're spending money, but in reality, you're servicing a mountain of obligations stacked above you. Pension funds manage over $40 trillion globally. Insurance companies control another $25 trillion. Banks hold more than $180 trillion in assets. And where do they invest it? In government bonds, the IOUs of nations. When the United States issues debt, pension funds buy it. When Japan does, insurance companies buy it. When Germany or France borrows, European banks line up to lend. On paper, it looks like stability. In truth, it's circular finance governments borrowing from the future savings of their citizens to pay for today's promises. Every taxpayer becomes both the borrower and the lender. The interest goes round in circles while the middlemen banks, brokers, and bureaucrats take their cut. Hovering above them all are the central banks, the Federal Reserve, the European Central Bank, the Bank of Japan. They have the power no empire ever possessed. They can create money out of nothing. When demand for government debt dries up, the central bank becomes the buyer. They call it quantitative easing. But that's just a polite term for something very simple, printing money to buy your own debt. It's as if a person could pay their credit card bill with another credit card forever. On the surface, the system looks stable. Underneath, it's eating itself. Global debt has risen from $84 trillion in the year 2000 to more than $315 trillion today. Corporate debt makes up $150 trillion. Households owe around $60 trillion. Governments owe over $100 trillion. And yet, there is enough real wealth on Earth to repay even a fraction of it. If everyone tried to pay back their loans at once, the system would collapse in minutes. That's because every dollar of debt is someone else's asset. When you repay your loan, that asset disappears from another balance sheet. The entire financial network depends on perpetual borrowing to stay alive. Economists sometimes call it mutually assured economic destruction. Every country holds the bonds of every other country. The United States owes Japan over $1 trillion. Japan owes itself $12 trillion. China owes 16. Europe owes 17. And they all owe each other. It's not a web of cooperation, it's a web of hostages. If one major nation defaults, contagion spreads instantly through derivatives, those complex contracts that link global finance. The notional value of outstanding derivatives is around $630 trillion, 8 times the size of the world economy. The problem isn't debt itself, it's that debt has become the bloodstream of capitalism. Stop the flow, and the patient dies. Who, then, are the creditors in this vast system? Not shadowy elites in underground vaults, but teachers, firefighters, office workers. Their pensions buy government bonds. Their insurance premiums finance public spending. Their savings sit in banks that lend to governments. Even tech giants play along. Apple, Microsoft, and Google each hold more than $100 billion in U.S. Treasury securities, not out of patriotism but because there's nowhere safer to park idle cash. The biggest lenders in the world don't even have faces. Algorithms now execute over 60% of all global bond trades. They don't understand fear, but they react to it instantly. In March 2020, the safest market in the world, the U.S. Treasury market, froze. There were no buyers, no sellers, just panic. The Federal Reserve had to inject $1.5 trillion in a single week to stop the collapse. For 2 days, the entire global financial system stood on the edge of the abyss. Most people never even knew it happened. Every debt system hides a hierarchy. At the top are the central banks and institutional investors. At the bottom are savers, workers, and small businesses. When crises strike, governments never rescue the bottom first. They rescue liquidity. In 2008, the banks were bailed out, homeowners were not. Executives kept bonuses, families lost homes. The same pattern repeated in 2020. Trillions went to stabilize financial markets, not to rebuild the real economy. Because in this system, markets come before people. Look at Lebanon. Between 2019 and 2023, its banks froze withdrawals. Ordinary citizens lost 80% of their savings. But foreign bondholders kept getting paid. Or Greece, where hospitals ran out of medicine while European banks were reimbursed in full. Argentina defaults once every decade, yet hedge funds in New York make billions suing for repayment. The pattern never changes. Creditors don't lose. They adapt. The cost of every bailout trickles down until it lands on the one payer who can't escape the public. The entire structure rests on one thing: belief. The belief that government bonds are safe, that central banks can control inflation, that money will always have value tomorrow. But belief is fragile. In Japan, the central bank now owns more than half of all Japanese government bonds. The government literally owes money to itself. It prints yen to buy its own IOUs, then pays interest from one hand to the other. Investors still call Japan stable. But that stability exists only because no one dares to stop pretending. The United States is on the same path. The Federal Reserve owns more than $7 trillion in treasuries and mortgage securities, roughly a third of the entire U.S. economy. Every dollar it uses to buy those assets is created out of thin air. It's not wealth, it's dilution. And it's accelerating. America's annual interest payments are projected to reach $1.6 trillion by 2026, more than the entire defense budget. Within 5 years, interest could consume 40% of all federal revenue. When a nation spends more on interest than on its military, social programs, or health care, that's not a sign of strength. It's a warning light blinking red. History shows what happens next. When debt grows faster than income, a reset follows. Sometimes it comes through inflation, sometimes through default, sometimes through war. Rome debased its coins, Weimar Germany printed marks, the United States abandoned gold, and in 2008, The world printed digital dollars. Each reset buys time but shortens the next cycle. Today, every signal points to another turning point. The yield curve inverted in 2022, one of the most reliable predictors of recession, and stayed that way for nearly 2 years. Corporate credit spreads began to widen in 2024. Consumer debt hit record highs, savings rates hit record lows. Commercial real estate faces $1.5 trillion in refinancing over the next 2 years at double the previous interest rates. The math doesn't work. The timing lines up perfectly with what economists call the Kondratiev cycle, a 50 to 60-year economic wave that has predicted every major crash since 1800, the Panic of 1873, the Great Depression, the 1970s stagflation, the 2008 crisis. The next winter phase arrives around 2026. But this time is different, because for the first time in history, every asset class is inflated together. Stocks, bonds, real estate, crypto all depend on the same cheap credit. When credit tightens, everything falls at once. In 2008, real estate crashed, but bonds were safe. In 2000, tech collapsed, but property held. In 1929, industrials failed, but gold survived. This time, there's nowhere to hide. That's the danger of the everything bubble. When the cracks appear, governments will do what they've always done: print money. They'll call it stimulus, relief, quantitative easing, but it's the same thing Rome did when it melted its coins and called it reform. Inflation will eat away savings, wages will lag behind prices, and debts will quietly shrink in real terms. It's the oldest trick in the imperial playbook: devalue the currency instead of defaulting. You can't default on promises if you can make the promises worth less. It's a perfect illusion, but illusions have lifespans. The moment people stop believing that paper and pixels represent real value, the illusion shatters. Every empire in history believed it was different. Rome thought its coinage would last forever. Britain thought the pound sterling would always rule the seas. America thinks the dollar will never die. They all said the same thing: our debt is manageable. Our people will always believe. Our system is unique. But belief is the last collateral, and once it's gone, no central bank can print it back. You are both the creditor and the collateral. Your savings fund the debt, your taxes pay the interest, your time repays the promises. Every hour you work, every bill you pay, every paycheck you deposit feeds the same machine, one that turns labor into leverage and belief into balance sheets. Maybe the coming reset isn't the end. Maybe it's the beginning of something cleaner, a recognition that real wealth isn't digits in a database, but the things debt can't buy: trust, time, and truth. So the next time you hear about government spending, interest rates, or another stimulus package, remember this: they're not talking about money. They're talking about promises, and promises, like empires, always come due.